Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Fear ramps up. Well, the stock market carnage has gotten worse thus far in March. Investors are now running scared that a recession could be on the way, and they're selling many of their big winners from the past few years. That's namely the largest growth stocks like Apple, Amazon, and Nvidia, among other names you probably know. In fact, the NASDAQ 100 index, which holds most of the well-known tech stocks, is down nearly 15% in the past month versus the S&P, which is down 10%. Now, while I wouldn't call this an outright panic, earlier this week there was a record volume of put options traded on the S&P 500, which are essentially insurance contracts that pay off when the market declines. Now, whether these were speculative bets on further market weakness or just investors clamoring to protect their portfolios, it illustrates a level of fear that's typically coincident with short-term buying opportunities. And while it's indeed possible that things get worse before they get better, I'd bet a short-term bounce-back rally is in the offing. Now, if you've been taking too much risk, that could be a welcome opportunity to lighten up on your exposure. For this week's featured insight, are you a trader or an investor? Trading and investing are two very different things. Unfortunately, a lot of people don't really know the difference, and the ease of online and mobile trading has created more new traders who think they're investing when they're actually trading. Warren Buffett's an investor. He claims his ideal holding period is forever, and indeed he's held many stocks for much longer than the average Robinhood user has been alive. And while you certainly don't need to adhere to Warren Buffett's time frame, most seasoned investors would tell you not to buy a stock that you don't see yourself holding for at least 3 to 5 years. In the 1950s, the average holding period for a stock was 8 years. The average holding period for stocks today, 5.5 months. And there are a lot of folks turning over their portfolios a lot quicker than that. Not only is short-term trading difficult, but the skills required to be successful are completely different than investing. Be sure to know whether you're a trader or an investor, and why. Looking ahead, Fed to the rescue? There's another Fed meeting next week, and part of the reason stocks did so well last year was the anticipation that the Fed would be able to cut rates with inflationary pressures starting to dissipate. And while they were indeed able to cut the Fed funds rate by 1 full percentage point last year, it wasn't nearly as much as many market watchers were expecting or hoping for. The rate of inflation does continue to improve, albeit slowly, and the Fed doesn't want to move any more quickly than it needs to. On the flip side, there is now widespread fear of a slowing economy and a jobs market that could be on the brink of a significant downturn. Therefore, the Fed has a real needle to thread here. Convince the market that inflation continues to improve alongside an economy that's still healthy despite some near-term headwinds, all while delivering an interest rate outlook the market likes without scaring it. Good luck, Fed. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.